Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here. This is the Investor Coaching Show. I'm Paul Winkler. So anyway, the thing that I was watching this week was this talk about the jobs, election, equity, AI, and there was a little piece. I want to comment on this. There was a guy on CNBC making some comments about all these topics, and I thought there were a couple points that were worth discussing here on the show. So let me play this.
2.5% to 2.75% growth. Almost touching 3% back in 2024. So strong growth with a weakening employment picture, high productivity, and a real risk that job creation is being stifled by innovation. And I think the Fed's not paying attention to that supply side driver.
Okay, so what's he talking about right there? He's talking about the Federal Reserve and looking at interest rates. What is the Federal Reserve thinking regarding interest rates? Are they reducing them, because there may be some threats out there? Are they reducing them fast enough? Now, we've heard this conversation a lot. Are they reducing interest rates to make up for this? Because if you look at job creation being stifled, what's he talking about there? Well, a lot of people are worried about it. Quite frankly, and they're worried a little bit about AI and worried a lot about it, as a matter of fact. Is it taking jobs? Is it creating a situation where people in upper income categories that typically are pretty safe when it comes down to job losses and fluctuations, maybe they're in a situation where it's not necessarily, it may be a little bit precarious. And is the Fed actually paying attention to this? It's a really good question, actually, because where is, if we look around and say, what is safer, when it comes down to artificial intelligence affecting jobs, what types of jobs are safer? Well, you think about it, some of the construction industries, right? And anything that has to do with that. There are a lot of people, and let me comment. I'm going to comment on, is it really that big of a threat to other types of jobs? Let me come back to that in just a second.
And that's dangerous.
And you think being less restrictive would somehow help? Or
I do. I think it would create jobs. I think it would create jobs in construction. I think it would spur housing. I think it would make the potential pain of a transition in many of these industries where technology is likely to cause significant displacements. It would ease some of that pain. And I think you're seeing that in some of the polling and in the voting. Even last November, Joe, we saw a lot of younger voters switch away from, the red vote that they had toward a...
Okay, so his point right there is, if you look at what AI is doing, it's a transition type of thing. There are a lot of people that are in jobs that, maybe are going to be displaced by this. And I was actually reading some thoughts from CEOs of companies, and I thought it was fascinating how they're using AI. There's a really good piece, and I know people laugh at me when they hear that I read Reader's Digest, but it is really, really pretty funny. But there was this whole thing about Reader's Digest, CEOs, and they would come up with problems, and they would say, or they would come up with ideas, and they would ask AI to poke holes in their ideas. I thought that was interesting. Another thing, this is a squirrel moment, but I got to tell you this is fascinating. They were talking about physicians, and they were talking about people with dread diseases or rare diseases. And what was super interesting is this whole idea of the pharmaceutical industry there's no money to be made in coming up with drugs for diseases that are rare. So what happens, a lot of these people, there's no treatment for what you've got. Well, they gave some examples of people that, and doctors that actually had issues themselves. And what they did is they were starting to do the research. And now because of AI, they're able to do research on drugs that are already approved by the FDA. And they're using them for purposes that they weren't designed to be used for, but they are actually helping cure diseases that previously there was no cure for. And it told me, and there was one story that was really interesting. This doctor was saying he had some kind of an issue. He had a patient with something. And as I recall, he had maybe a two-week life expectancy, a really short life expectancy, not much at all. And the doctor says, we tried this, we tried chemo, we tried this drug, we tried this drug, we tried this drug. We tried everything. There's nothing. This guy is not expected to make it. And the doc that had been using AI said, well, you might want to try this. And he says, that's a weak drug. Why would I do that? That doesn't do anything. He's, what else do you got? What do you got to lose? And he's like, yeah, good point. Go try it with a guy and actually cures him, puts him in a remission. And it was just example after example of these types of things and how it's being used, and examples of people in different positions that are learning how to use it as a tool to make themselves more productive and more effective. And I think that's the better way to look at it. Is how can I use this to my advantage? And so, I'm a fan of, can it be misused? Can it be, are there negatives? Oh, always. Always with anything. Can there be ethical issues? Oh, absolutely. No question about it. But it can be used quite effectively. But his point right here is there could be the short-term displacement you got to be really conscious about. But I want to get into how this affects, because this is a show about investing. How does this affect markets?
Vote, and a lot of that polling suggested there's a frustration with the job outlook and affordability and the like. So I think we have some real issues going into November with job creation, politics, and what that means for the companies that we're all looking at that are seeing incredible returns on capital, incredible growth opportunities, but leaving a wake of employment risks. You wouldn't be fading strength. You'd be buying dips. In fact, you wish it had been more volatile. You're talking about equities as well? Yes. Yeah. On the price action that we've had, everyone to a person that I speak with has been surprised, some pleasantly and some unpleasantly, at how resilient the risk asset markets have been, how resilient the long end of the bond market has been.
I'll stop it right there. But the point being is that equity markets have done quite well, thank you. And you go, well, wait a minute. A lot of pessimism out there, a lot of fears, a lot of fears about people's jobs and those types of things. And that has been what has been creating a lot of this, is this increase in productivity at companies. And companies are using these types of things to increase output. They're using it to actually make themselves more efficient. And this is the thing that's so tricky about stock markets, is that you can have negative stuff going on. You can have bad things going on. You have wars going on. You have oil prices, and they've been looking at it and going, man, the oil price has been, had been jumping like crazy. And yet it wasn't negatively affecting the stock market. Why? Well, there could be any number of reasons. It could be that people are looking beyond this news and they're saying, I could see where this could turn out really, really good. Maybe that's part of it. Maybe part of it, though, is just productivity, and a lot of the things that have been happening at companies in general have been very, very positive. And that's why he's talking about risk assets doing so well and people being pleasantly and unpleasantly surprised. That ought to actually catch your attention. In other words, there have been people that have been surprised on both sides, pleasantly and unpleasantly. Maybe unpleasantly because they pulled out of the stock market, and when it went up, they weren't there. That's the big thing you got to watch out with market timing. You got to be right twice. You got to be right when you get in. You got to be right when you get out. And as I've talked about forever on this show, people just aren't very good at it. Case in point. So it's just interesting stuff going on. People will be watching the Federal Reserve. They'll be picking on them and, forever. But I don't think it's going to end anytime soon. But there are reasons for this to be happening. So we'll just keep an eye on it and go from there. Paul Winkler, you're listening to the Investor Coaching Show right here in Super Talk 99.7 WTN. Again, this is my whole thing, is don't have to be able to predict the future to be a successful investor. You just have to stay away from traps like stock picking, market timing, and using past performance. Always been my message, and it will continue to be so. I'll be back right after this. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, there are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. Yeah, we talk money and investing around here, and questions are welcome. paulwinkler.com. You can go there to the content section of the website, ask questions there. paulwinkler.com/question/questions. Either one of them will get you there, and you can ask questions there. We'll shoot you an email, let you know we answered the question. Another one came in. That's what I'm telling you right now, because another question. How many years, Henry's asking, how many years of expenses should one keep in bonds to draw from in a downturn? A good question. Okay, so when I look at an investment portfolio, let's say that I have an all stock portfolio, or I keep it all in very high risk assets, and I'm trying to live off of this in retirement. It can be a real problem because of something that we call sequence of returns risk. And that's just basically that, when I have two portfolios, I can have one, let's say, that has a 10% expected return. And I have another one that has a 10% expected return. Both of them have returns that are the same. And if I'm, let's say, drawing an income from that, and all of a sudden, I heard one financial person say, you can draw a higher rate of return, like 8%, something like that from a portfolio. And I'm going like, there is no research. Have there been periods in time when you could draw that level of income, 8% of your portfolio? Yep, no question. There are periods, but you have to have some pretty good conditions for that to happen. You have to have market up, in the early years, and then it goes down later on. So that would be a situation where you have, let's say the market goes up 20, and it goes up 25, and then it goes up 13, and it goes up 10, and then later on the market goes down. Well, it's no big deal, because in the early years, your return was so much higher than what you were drawing, your portfolio kept growing in value. By the time the negatives came later on, you know what, you don't have as much life left, and you had all of those extra returns in the early years, it helps carry it. So that, that works in those particular scenarios. Now, if I have a situation where I have a negative return, and let's say that the market goes down, and I'm in a portfolio that's, let's say it goes down 25%, and then I draw 8, well, now I'm down 33%, right? Now now I have less money that comes back. And then it goes down another 10%. I'm like, oh, crud, and I've got to draw the 8% out. Now I'm down another 18, on that. So if you look at it that way, you go, man, that could be, and it'd actually be even higher than 18 if I kept the 8% constant. But man, I'm not going to get in the math here. It didn't blow people's minds. But anyway, we've got a lot of engineers. I should say it wouldn't blow the engineers' minds. A lot of very sophisticated listeners to the show. I take that comment back. But anyway, the idea being that sequence of returns risk can really ruin you as an investor, because when the market goes down, you have to not only deal with the market downturn, but you're also withdrawing money from it. So that's why you hold bonds. How much? Well, the studies show, and when one study was looking at how much I should hold in bonds, and typically, you're looking at how many years of withdrawals. Let's say if I use a 4% rule, and I use that as my distribution amount, and I increase it for inflation each year. Well, if I have, let's say, 40% of my portfolio in bonds. I've got 10 years of downturn money sitting there in bonds. And our worst stock market downturn ever in history was 29, 30, 31, and 32. So you had a 4-year downturn. Well, if I had 10 years worth of distribution sitting in bonds, I was fine. If I did a 50% mix, it's even more right there. If I had 50% in bonds, 50% in stocks. But that's typically around where I'm going to stay, is somewhere in that neighborhood. You could go up to, I actually have a whole workshop where I wanted to show the past 25 years actually using actual client returns, taking a distribution from a 75% stock mix, 25% fixed income, and it was okay to do that. It really, a lot of it depends, and a lot of it depends on your level of flexibility, how much you have in bonds versus stocks. The more flexible I am, in other words, if the market's down 1 year, I just take less income. The more I can hold in stocks. That's about the best answer, but that gives you some kind of an idea. 60% stocks, 40% bonds. That's pretty typical mix for me. I use that quite often, but I may use a little bit more or a little bit less depending on the person. Henry, thanks for the question. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.